What's up? Good evening. I think it's been a while since I've done a live stream at night. Give folks a sec to get in here. As you come in, you should have hit the like button. Put any questions that you may have. Awesome. Cool. All right. So, I want to start off by talking a little bit about how I view potential businesses that we're acquiring in the funds, and how it's very much different from how I view them if I'm going to buy them personally. When we're buying deals within the fund, obviously we're using a set of criteria that's going to generate the highest ROI for the fund. And at a basic level, when somebody's buying a business, it's usually for personal income. And those two things can actually be at odds with each other. So, as weird as it seems, you would just think, okay, the goal is to buy a really great business. One of the trainings that we go through in the private equity fund incubator is around the origin of private equity. And a lot of people don't make the connection because an amazing PR job has been done. And they've really done a great job of naming private equity kind of something that gives you a sense. It's like, hey, you invest in public equity, and then you invest in private equity. But the origin was around corporate raiders. And so, up until the 80s, all of the people and some of the names you'll recognize, T. Boone Pickens, Neil Peltz, um, Dan Bilzerian's dad, Paul Bilzerian. There are all these corporate raiders. And so before the times of KKR, which was one of the firms that sought to create a brand around private equity, before those, it was really just a bunch of individuals, and they would put together these deals. They would go into the business, and they were known for being very aggressive about generating really great returns. And when you study that history, it really becomes obvious that for those folks, when you're using those strategies of a corporator, you're definitely not using the same strategies that someone who's just looking to buy a small business and have that business pay for their family's needs. And for us, it's really difficult to make that kind of assertion that we're using corporate strategies. But I think there's a veil around private equity where people have forgotten that most of the strategies originated from these corporate raiders who would go in and basically buy these companies with the concept of maximizing ROI. And a lot of times, maximizing ROI meant a lot of different strategies that had nothing to do with just, oh, okay, I bought this company, now I'm going to become CEO. I'm just going to run it for the next 10 years and maybe I'll sell it one day. There's a lot of other things that you can do in that deal to maximize the ROI in a short period of time. For us, the reason that analogy and understanding that history is important is because we are doing 2-year funds. So, all the funds are very short term. Some are shorter than others. We had Peppy 2, which was like just had a bunch of things where the guys were all very busy. So it was a shorter thing of just, okay, let's just go ahead and wrap this up. Have other ones that are longer. So, Peppy 1 went really almost to the max, and literally we've got a deal that We're still kind of exiting, even though we essentially closed the fund. So we closed the fund, and now we're trying to exit this other deal. So when we're looking at these things, it's a very short term period of time. And so we're trying to get into whatever deal, we're trying to maximize our ROI in a short period of time and then get exit out of that deal as quickly as possible. Um, so one of the ways that we talk about businesses is not looking at the business as if it's just this one whole thing. Liking it to a galaxy. If you're looking at the Milky Way galaxy, there's all of these different, planets, solar systems, stars, there's moons, and blah, blah, blah. And, if you're taking this big picture of the universe, there's not anything to say that this is the Milky Way galaxy. It's just a name that we came up with to call it that. Businesses are pretty much the same. Like the business itself doesn't really exist. It's a bunch of moving parts that we've put together and then we give it a name and say, this is such and such business. And it's important to look at the business that way so that you can start to break up those parts and understand where there's value, where the assets lie in that business that can be turned into income, cash flow, and ROI to the fund, and where liabilities are that aren't going to give a good ROI. And so the way that we view it is that these are assets that we're trying to put into the fund, and all of those assets want to be accounted for so we can maximize the amount of our ROI generated from each one of those smaller assets. So when you're looking at that business, you have different individual employees, but obviously those employees aren't just a part of that business. They have their own lives, they have their expertise, they have their backgrounds, they have their education, they have all of these things. And the most basic level of how you want to think as a private equity is understanding, hey, what are all the things that this employee really can bring to the table that maybe we're missing out on? And so that kind of question comes into play when you're not just saying, oh, here's a business. And the average business owner or business buyer, and even when we're training people in Deal Makers Institute, just go out and buy a business. What we're doing with them is we do want them to look at that holistic business. We do want them to study essentially the Milky Way as opposed to all of those individual parts, because what you want to buy is this whole system that works. You want to buy the machine. You're essentially buying the car, and you just want to know if the car is going to run, because you need that car to take your kids to school. You need that car to get you to work and blah, blah, blah. You're buying that car for the purposes of getting around. And so you want to do due diligence on, the whole business or the whole car. You're doing due diligence on that whole business and trying to make sure, does this black box, is this thing going to print out money? I want to just make sure that when I buy this black box of a business that, every month I'm going to get out this amount of money. I don't want to have to go in here and tweak all of these different things. The way to look at it is that the private equity fund isn't going to use that card for anything. It's not going to. It doesn't need. It's got a bunch of cars, so it doesn't need this car to drive to work or to take the kid to school. So it's like, okay, what are the parts in this? Maybe I can take a part from this car and improve this other car and be able to sell that for a higher value. Maybe I can put some more paint on this car and sell it for a maximum value. So you want to understand all of those individual parts and understand how to get the maximum value from each one of those parts. And a lot of times what we end up doing is we go in and we look at these deals like a startup. We're basically just looking at the business from the perspective of, if I just had nothing and I got this business, what would be all the things that I would just use this to start? What are all the things that I would use this to create income from nothing? So it's a bit of a paradigm shift, and you want to make sure that based on what your purpose is for that business, if you're going to own that business for the next 15, 20 years, like I said, it's going to be the provider for your family. How you do due diligence on that business is very different than if you're kind of building a portfolio, or you're especially managing a firm. And it changes even more if it's a shorter lifespan fund than if it's a 10-year fund. You know, if you are KKR and you're just like, hey, if we just buy this thing, we're going to buy it at a 10x, and we're going to own it for 10 years, we're going to pay for itself for 10 years, and we're going to sell it. That due diligence is much different than doing the deal, and you've got a 2-year lifespan fund, which is what a lot of ours are. And if you're like Peppy One and getting a 300% return during that period, there's some very aggressive things that have to happen in order to generate those kinds of returns. And that's why it does fall a little bit more in line with that corporate raider attitude. And it really, again, I like to use the word corporate raider because it gives the reality of what private equity is. Private equity is still the same strategies that the corporate raiders were using. They just realized that this is a terrible name. In the 80s, there was a huge amount of backlash. Paul Bilzerian, Dan's dad, actually, I think he ended up in jail for a while for some of the things that he pulled. So some of the things were just completely over the line and illegal. But before they reached that point, it was just the idea of being very, very aggressive in how you look at that business, not as a business owner, but from that private equity perspective. Awesome. All right. It's late, so I'll do a couple of responses and we'll bounce out of here. Yo, hit the like button as you come in. Hit the like button, guys. Avery, what's up? So Avery asks, how do you reach out to investors for your first e-commerce acquisition? So a great way to find, and this is for whether it's e-commerce or SaaS or whatever the type of business is, it's great to know that you want to do a specific type of deal. But I would get into communities that are teaching people how to build those businesses. So if you're, there are just endless Facebook groups, there are endless Discord groups that are training people and having discussions around e-commerce. And one of the best things to do is to get into those communities and start to be helpful, because people are coming there and they're asking questions. And something that's funny is that most of the questions are Googleable. People just literally prefer to go into those groups and type the question to a group of people, and obviously get some different answers. But a lot of the times, it's not very complicated questions. And so, if you can go in and start to be the person that's known as the most helpful person in that e-commerce Discord or e-commerce Facebook group, then you'll start to build a lot of those relationships. And what you'll find is that most people don't want to, or they do want to build something from scratch, but they're not going to be successful. It's just literally, it's not that they're not great people. It's not that they're not smart. It's not that they're not capable. It's just the lottery. It's just the numbers. The statistics work out that most of those people are going to end up frustrated because they've tried to build one thing, two things, three things, and they never end up making money, and never end up making money from it. And so a lot of those people end up being great potential partners and investors for you. And so you can go back to them and, you want to get to know them. You want to build a relationship with them. And your goal at the end of the day is to obviously have a network of people that are in the industry that you want to work in. But in addition, what will result from that is some people that will see the opportunity when you tell them, hey, how you haven't been able to build a business that has made money. Well, I found one that is making money and it's available, and I want to buy it, and I'm putting together the capital. Would you like to partner with me on it? And the other great thing about those kinds of investors, which if it's your first deal, is a valuable thing, is you don't want to try to do everything yourself. Those are people that will also be willing to roll up their sleeves, help you to make the business work. Thanks for that question, Avery. Great question. Also, if you're interested in kind of a deep dive, we go through in Dealmakers Institute building a funnel for raising capital and all of that stuff. So you can get more complicated with it, but just as a basic kind of thing, is that would be where I would start. I have no idea what board Joe means, but hopefully you're getting some value out of the live. Melissa popped in. What is up? Thank you for popping in here. Derval asks, let's see. What's the difference in due diligence process for long-term versus short-term acquisition? So part of it is not even whether it's just long-term or short-term. It's about what's your goal with that business. And that's what you're really just working backwards. So I would really change it to be, if it's a business that you're going to own for cash flow, or if it's a business that you're trying to get a strong exit out of. So if you look at those two comparisons, the business owner, the most important thing for them is consistency of the income. So your due diligence process is going to be built around, how can I ensure that I'm going to continue to get this income? Will I be affected by different cycles in the economy? Will the supplier, have issues? Do I have other people that could supply the products or services if that becomes an issue? Do I have bottlenecks in my employees? And so it's really based, and obviously, Duval, you're in the program, so that's the normal process since you're in Dealmakers Institute, where we go through the 88 different things that we're looking at in the business. So that is the Dealmakers. That's the normal process that we discussed. That's what you're really building around. With the funds, what we're looking at is maximizing ROI. And for a lot of people, they think that's the same thing, but it's just two totally different things, because maximizing ROI could literally mean that we're licensing out the database. We did that in a deal, and creating other competitors, which is something you would never do if you wanted that income to last for a long time, because we're literally cannibalizing our own business. But at the end of the day, in that short period of time, we end up making a 200-300% return on the business, which is what we want to get out of it, and then we can still sell that business for less. So that's just an example, but the idea is you're looking at that business from the perspective of it is short term, but it's also just from the perspective of an ROI. And part of that means exit. So if you're doing due diligence as a business buyer around the income, let me turn this off so we don't keep getting these notifications and messages. All right, where are we at? Cool. So if you're building due diligence around a process of ensuring that your income is going to consistently come in over the course of years, as a business buyer, on the opposite end, as a fund, you're basically building your due diligence around, how can I maximize this exit? So if we've done a deal where we take that deal through the crowdfunding process. In that case, I could care less about the income at all. If we've got a crowdfunding strategy, really our exit is, we're buying that business at a 3 multiple, and we're going to sell it at a 20 multiple. If we're buying a business that's a strategic buy, we did a deal where we bought a business and we basically had all the businesses that needed that service. And so it had very little to do. The due diligence in that case is built around, hey, we have these number of companies that need this service. Which acquisition can we buy that can provide that service the best at the lowest cost and provide us the biggest margin? So it literally has nothing again to do with the income. And so it's you're building a due diligence around what your goal is really what it comes down to. So it's not so much about long term, short term. It's just what's your goal. If your goal happens to be long term income, then you're building a due diligence process around that. If your goal happens to be as a private equity fund that you're looking for a strategic partner for one of your businesses, then that becomes a thing. We've made an investment in a deal where that deal we're trying to push to acquire another business that we own. And so there it starts to be all of these different things. There's buying a deal for leverage. There's buying a deal to get access to the credit line that they have. You can buy business like care nothing about the income, care nothing about all the things that a business owner wants, because you're going to leverage their credit to go and buy a whole new set of businesses. All of those things are what you're building potential due diligence processes around. Hopefully, that is helpful, sir. And thanks for that question. Actually, this is great. Power School says, great question. Yeah, that's such a good question, because I did focus a little bit on it, because our funds are very short term, that, I kind of focus on that being the thing, but that's not really what it's about. That's like one aspect of what you're building your due diligence process around, but that's no way like the end. It's like you have all of these things, but you're building your process around that. Stephen Hart, what is up? Stephen A. Hart. Yes, thanks for popping in. Good to see you. He says, been a long time. Indeed, it has. Indeed, it has. Thank you for popping in here. I'll do this last one and we'll bounce out. It's been a bit of a long day. Mr. Alvin R. Dixon asks, what kind of information should one be getting to develop a million or billion-dollar brain? Million-dollar brain. So I did have that series, and that was a lot of fun. We did the million-dollar brain series. There's so much. I mean, that was like a 8-part series that we did. I think at the foundation, it's trying to build a straight line to the end goal. I think most folks, when they're looking at different opportunities, they're looking at potential businesses and all that. It starts to be this whole thing of like, okay, I'm gonna get all of these different skill sets. And I want to buy or I want to buy a course around learning how to become the best coach possible. I want to buy. Sorry, we got distraction in the background with all the apes. I want to buy a course on Facebook marketing. I want to get really good at being an influencer. I made a joke on Instagram about all these old people that are on TikTok. It's just like everybody's trying to get all of these skills. And I think one of the most powerful things in general that you can have, I think the literal superpower right now is focus. Like there's so many people that are so distracted with so many different things that like you think it's a natural thing to say, oh, well, the more things I get, the better. And that used to be the case, like in, before the 2000s, like that was the case. The more things that you could do, the more things you could kind of learn about, the better. Now, because nobody has focus, the most powerful thing you can do is get really, really focused. And what that means, as far as just kind of action is, number one, closing everything out, having a straight line process to get to the income that you want to get. Obviously from my perspective, part of that is just acquiring the income. that you want to acquire. Um, but whatever the end goal is, trying to cut out all of the different steps. So right now, everybody has a goal and they're thinking, well, I'm going to go over here and I'm going to do this step and I'm going to learn that and figure this out and I'm going to go over here and then I'm going to do this other step and then I'm going to grow my audience and then I'm going to have an email list and I'm going to have this landing page and then I'm going to, and so it's all of these different things and you're just running around trying to complete all these things. And the more that you can simplify it and just say, hey, like here is the straight line to where I'm trying to go, and just go get that thing with the end goal. If like you're like, oh, I'm going to do all these things because one day I want to make $100,000 a year. It's like, well, where's the $100,000 a year already been made? Because it's already been made by somebody out there. Let me go and get it. And so you just figure out who has that and how can I offer them something that allows me to get it. So that different way of thinking, I think, is the number one skill set, the number one ability around building and developing $1 million brain. Real quick on this, Alvin asks, what are your thoughts on real estate notes? I invest in some, so I guess that's a thumbs up. Obviously, with everything, it's you've got to do due diligence and understand it and all of that. Ats Capital, New York engineer. Thanks for popping on. Blue ocean strategy. Yep, that's I think literally that is what is a blue ocean right now, because everybody is trying to be the biggest thing on TikTok and Instagram, and they're trying to do all of these million things, and then going from the hot trend is, okay, I'm going to become a stock trader, I'm going to do forex, I'm going to invest in this, and you can get there, but the key is like whatever the one thing is, that's going to be the one thing. And then before you go to all of these distractions, I mean, there's just multi-billion industries built around distracting you. And now, in addition to that, there's $1 billion in little small entrepreneurs that are gurus and that kind of thing that also want to distract you and say, hey, no, your goal isn't the right goal. You need to come over here because this is the goal that you should have. And joining our course is where you want to go. Near injury, great point, focus. Michael Ramsey, what's up? Have you done any artificial intelligence related deals? Are you planning to soon? So we're actually, shout out to Kay and Peppy3. We're using and testing. I mean, all of it's so early. We are using some AI in one of the deals. He's actually, I'll just tell you, like like I said, I like to keep things really simple. So I'm glad we're doing it. He's doing an amazing job. It's great. It will add something to this acquisition once we exit. But I'm like, it's early. It's early, so it's gonna be a while before a lot of that stuff is really doing. I don't know if y'all saw, India had a pretty funny. Their government had a pretty funny story about using AI that they had to shut down because it got a little crazy. Alice says, thanks. I'm glad that was valuable for you. All right. I said 5 questions goes the last one. These are kind of running in. This right here will be the last one because it looks like a long one. I can't see exactly what it is. Cool. John, what's up, man? As a young deal maker, 18 years old, is leveraging an industry expert on your team enough for raising capital and negotiating seller financing, or are these more steps needed? So here's an interesting thing that I don't think I've talked about it, but I've never really explicitly explained one aspect of the deal that I closed when I was 19. And this is even a much bigger possibility today. So the deal that I did when I was 19 was buying a stock market simulator. I bought it from these two guys that built it. And the thing that I hadn't really expressed, I guess, is that they were also young. And so we connected in a originally in a little forum thing back in the day, and they had built this business, and I was using the platform. They had moved on to another project, and but it built a relationship with them, and so that's how I ended up buying in a $70,000 business, doing $60,000 a year for with $3,000 out of my pocket. And so part of that, and what I would encourage you to do, is to try to do deals with people your age. um, I think that just makes everything so much easier. You're going to be able to bond, connect with them. Again, you're going to benefit because this was even back then. Like they had, entrepreneur ADD. They had short attention span. So they had a really great business with a lot of potential, but they moved on to the next thing because they lost focus on that, and that I was able to come in and take advantage of that. So that would be my whole strategy, is to find, build relationships with other young entrepreneurs that are going to build the businesses and do deals with them, so that you're able to get those businesses. And then once you have a way to get deals, and you can get really good deals that aren't on the market, raising capital isn't the issue. Just as an example, I just saw my homies. I'm very, very proud of them. We were starting in this stuff years ago. Empire Flippers, hanging out with them in Asia, and just like ragtag, man. We were trying to figure out all this stuff, and they were starting the brokerage. It was just those two guys, and so say all that to say that they literally had just put up. They've got over $100 million of people who have basically said they've sent the proof of funds, they're ready to buy a deal, they want to invest in a business, and it's just sitting there waiting. The money is not the difficult thing. Your ability to go out, be focused, get great deals, negotiate, due diligence, all the stuff that we teach and talk about. That skill set is what's needed. They're printing trillions of dollars, hundreds of $1 million sitting at Empire. I get people that I turn down investments from. The reason that I'm training people to do these funds and use their capital initially to go out and do this stuff is that creates more people that can go out and implement these strategies. So that's the key. Is if I were young, that is what I would be spending time doing. All right, that's the last one. I will definitely be back. It looks like night is a good time. There's a lot of great questions that come in, so I'll definitely try to do some more of these at night. Be sure to like, be sure to comment, and hopefully y'all got some value out of the day. If you're interested, we'll have the next private equity fund incubator coming up in a couple months. So go to acechapman.com and find out more about that. If you're interested in acquiring your first deal, which sounds like a few of you are in that mode, go to dealmakersinstitute.com, reach out. We'll schedule a call and see if it's a fit, and would love to work with you. Thank you all so much for